Hello, Greg. Greg, can you hear me?
Sorry about that. I was muted out. Yeah, no, I appreciate everybody being here today.
Yeah, we have a really large turnout today, so I'll just let everybody know what we're going to sort of do here. I'm going to start the presentation off just by just going over some information about the REO industry, what's kind of going on in the world out there today. Going to spend about 10, 12 minutes on that. And then I'm going to give the controls to Greg, and Greg's going to take us through a presentation. What we're going to be talking about today is very unique. We had one webinar on Tuesday with this. It was extremely well received. We expect a big turnout. We're not going to be able to open up the microphones just because there's too many people on here. We'll just get too much background noise. But what we're going to do is we're going to take questions at the conclusion of today's webinar. So if you look to the right of your screen, you've got a dashboard. On that dashboard, there's a little button that says questions. Excuse me. If you just click on that button, you can then type in your question. And go ahead and feel free to type in your question at any time during the webinar. We'll circle back when Greg is finished, and we will answer all of your questions. So with that, we will go ahead and get started. Just some industry news, just to kind of bring everybody up to date if you're not following what's going on in the real estate world. This was pulled off just about a month ago. Case-Shiller, one-year price gains through March of 2013. And you see some of the areas. I just pulled off a few areas that most of us are familiar with. These are markets that have been typically were hit very hard by the foreclosure situation in 2008. Phoenix up 22, San Francisco 22, Vegas 20, Atlanta's up 19.1, Detroit up 18.6. The chosen market that we are in, Birmingham, Alabama, was up 17.2% in 1 year. I live in Orange County, so just LA, Orange County prices are up 16.6%, and Orange County is now rated the #1 most overinflated real estate market in the country. And a lot of people always ask us, why are we not buying foreclosed properties in California or some of these other locations, these other areas that were hit hard by the foreclosure meltdown? And the answer is just real simple. It's just math. And Greg's going to get into some of the reasons as to why as we talk about the markets we're into. But this particular article here wanted to say, yes, home prices are up double-digit rates, big deal. They are still way below the previous peak, and this is the reason why I think we're still seeing the institutional investor that's investing heavily in this market. This is a really good article. I've sent this out a number of times after last week's webinar, or Tuesday's webinar. If you want a copy of it, let me know. I can send you the link, or you can just go to the Time magazine. But this is an article that featured a group that was heavily invested in the real estate market, saw the bubble about to burst, sold their portfolio, and are now re-engaging in a very heavy way. This goes on to talk about why investors are betting on the housing rebound. And we're going to talk about that a little bit today. Again, Case-Shiller Home Price Index, just some more statistics. If you just Google what's going on in the foreclosed housing world, or if you Google the state of today's real estate market, all kinds of stuff comes up. And what you're generally going to see is you're going to see the fact that the housing market is rebounding. And there's a lot of reasons why. I'll touch on some of that as we go through this. National Association of Realtors, something that we follow quite consistently, talks about how prices jumped 9% in 2012, the largest increase we've seen in 5 years across the board in this country. And home inventory levels hit a 5-year low. Now, that's an interesting statement because, I think most people still think there's all these foreclosures coming out of the market. Not necessarily true. It is true to some degree. There's still a strong market out there. But what you've really got now, you've got lots of institutional investors that are in this business, not just a small investor like you may be, but you see a lot of institutional hedge funds or real estate investment trusts that are aggressively out there turning this into an industry where you buy single-family homes, fix them up, rent them out, and then that's a business model now, and that's causing prices to go up. Some more statistics from the National Association of Realtors: 84% believe that real estate values and number of transactions will increase in 2013, so a lot of optimism there. 77% believe that new construction will begin to increase. 74% believe that their local economy is going to improve in 2013. That's an amazing thing to me, because if you think about what we've been through the last 5 years with all the fiscal challenges we face in this country, for people to be thinking that, this year we're going to see some improvement in our economy, that sort of optimism is really, really good to see. And then no market's expected to see a decline in home values or real estate transactions in 2013, where we saw 1/3 of the market see a decrease in transactions in 2012. One of the reasons that we're seeing this is that hedge funds have entered the industry in a fairly big way, and we believe this all sort of started, at least aggressively started, about a year and a half ago when Warren Buffett was interviewed by MSNBC and said that They asked him the question, would you invest in single-family homes? And he went in to talk about, why the best place to invest your money today was in a single-family home. And then he went on to say that, I would buy millions of them if I was handy, but not really good at fixing up houses and that sort of thing. And that sort of frames what we do, not just REO reseller, but the specialized REO industry as a whole. There's an industry out there now, companies like ours, that are doing exactly that, identifying real estate at the right prices, fixing them up, renting them out, turning them into a cash-flowing real estate model. Hedge funds are doing the same thing, and we are actually interfacing with hedge funds today. The one thing that hedge funds don't have that we have is infrastructure on the ground, a presence in these markets that enable us to do what needs to be done to make that all work. Incidentally, Warren Buffett didn't just say that real estate was a good investment. He went out there and he bought Prudential Real Estate. So now Warren Buffett, as part of his investment portfolio, owns Prudential Real Estate. And so one of the questions you have to ask yourself, this was probably late last year when we started began to wonder, well, we're seeing this institutional money now that's buying up real estate. Is that a good thing or a bad thing for us? Is it good for our investors? I pulled this article off the internet around, I think, February of this year, and it actually went into this long description of why you should hug a hedge fund buyer and why that's a good thing for all of us. It actually cited 5 reasons as to why it was a good thing for the smaller investor. I used 3. I think these are relevant to our particular customer. First of all, the driving up prices. That's clearly the case. Interestingly, where we will see hedge fund buyers in the market buying, product at list or asking price, where we've traditionally been able to say, hey, we're going to offer a little bit under that price. And typically we're able to do that. Hedge funds were buying typically right at asking price or list price. And when you would talk to them about why they were doing that, they were saying, well, it's still great values. We may be paying what they're asking for, but we still know those properties are undervalued. And, of course, we know the same thing. And our prices for the first time in 18 months did go up. Our prices went up about 30 days ago for the first time in quite a while. But they are clearly driving up prices, and they're also the cause primarily of the fact that we have low inventory levels in the market. Hedge funds are buying undesirable property. They buy off what they call bulk list and tapes. We're going to get to that in a few minutes when he talks about his when he starts his presentation. But they will buy those bulk lists and tapes. We don't do that. We cherry pick. But this is a good thing. It's a good thing because there are some neighborhoods that have homes that have been on the market for months, if not years, and those homes are in poor condition, and that drags down the value of the entire neighborhood. So them buying those underperforming homes is actually a good thing for the entire market. And then finally, it provides an aftermarket. There's people in the market now that are looking aggressively to buy as many single-family residences as they can, especially when they're rented out and rehab. And so it provides a market there, and that market there is a powerful market. We have learned at REO Reseller how to tap into that market to the benefit of our clients. So having that aftermarket for that presence in the market is a good thing. Having somebody there that has a thirst to build their portfolio, whatever your strategy may be, whether it be short-term or long-term, at some point you're going to want to exit. Greg's going to talk about a unique exit strategy on today's webinar. But having that institutional buyer there with a checkbook that, by the way, exceeds $9 billion. That is the amount of money the hedge funds have committed to the real estate market. Now, let's keep that in perspective. The overall real estate market, I believe I read, was something like $17 trillion. But still $9 billion to buy single-family homes for rentals is a huge number to have in our marketplace. The thing that we just recently learned, and actually we've sort of known this for a little while, it was sort of below the radar, but we had a webinar earlier this week with a group of Chinese investors, and it's clear now where they were typically once only buying into typically commercial properties, hotels, hospitality. Now they're getting involved in, single-family homes. And as Steve Collins, the international director of Jones Lang LaSalle Capital, said, they're just getting started. They're just now starting to enter this market. There's just been some incredible wealth creation in this market. I'm quoting from him now. And so you're seeing, well, first of all, you saw one group invest $500 million in Blackstone. If you don't know who Blackstone is, that is the largest buyer of single-family homes in America today. They are a large hedge fund buyer. We do interface with them as well. So you've got Chinese money flowing into that. You've also got money flowing into the housing market in general now. And we are just now beginning to work with that particular market. I've used this now for almost a year and a half, and it's interesting when it says, well, this is from CNBC, while home prices still haven't hit bottom nationally, demand is starting to grow. Well, first of all, 15 months, 16 months later, yeah, demand grew all right. Prices are absolutely not at the bottom anymore. They are climbing back up. There's no statistical indicator that you'll read anywhere in the country now that will show you that housing is going down. It's going up. There's no question about that. And then it talks about, large-scale investors like hedge funds have gotten into the marketplace. Well, that's true. We've witnessed that. We've seen it. We know what they're doing. So CNBC was very right on that. And then it talks about, how does an individual investor without extra cash lying around get in retirement funds? And yes, we do these webinars with a number of third-party administrators, Direct IRA, Active Plan, and Trust. So we do webinars with third-party administrators that then, we talk about what we do and how we create a sort of a passive income stream using real estate as the underlying asset. And then the third-party administrator will go into, how do you do that with your 401k or your self-directed IRA. It's a great way to participate in this industry. Most of our transactions that aren't institutional transactions are through, through a third-party administrator. Somebody's liquidating a 401k, or they want to set up a self-directed IRA to direct those funds to a piece of real estate. And it's a great way to rebuild your retirement portfolio. It's a cash-flowing piece of real estate. There's some tax benefits there. You get monthly income from it, and you're in a market that's going to appreciate. And so all those factors combined is good. It's a beautiful way to be able to invest through your 401k or your self-directed IRA. It is the same exact reason why you see hedge funds doing it. It's the reasons I just cited: cash flow, tax benefits in a market that's currently down and is showing the strength to appreciate over a long period of time. That's my presentation. I'm going to turn it over to Greg now. I want to thank everyone again for being here. And again, we will take questions at the conclusion of the webinar. So if you have any questions, just type them into the chat box there, and we'll be glad to take those at the conclusion of the webinar. So with that, Greg, again, I want to thank you for being here, and we'll turn it over to you.
All right, thanks, Charlie, very, very much. I'm going to apologize up front. My allergies are out of this world today, so if I have to pause from coughing or sneezing. Anyways, yeah, I just wanted to go over some basic information here. I know that there's some people that have been on before, but I see that there's a lot of new faces today, and we welcome you being here. REO Reseller is a company that I started. We actually started in 2007, which was a little ahead of itself, but incorporated in 2008, and we were really ahead of the whole foreclosure meltdown. We have become basically a one-stop shop for investors who want to get on the right side of the foreclosure boom, not necessarily having to be an expert. I will tell you, and I know many of you heard this before, the more that you know about us, the more that you know how we operate and how we do business. You don't have to know anything about real estate, but the more that you know, you'll actually appreciate more of exactly what we do. All right. This slide is very, very, very important. Charlie had mentioned, about these hedge funds. They buy things sight unseen. They buy off these lists, bulk tapes, etc. We research the area. We're going to talk about, where we're at. And when we're in an area, we dominate that area. Okay, so we only do one area at a time. We have ground teams that literally look at over 100 properties, and we need to change the slide because it's not cherry picking and getting 10, it's cherry picking and getting 5. The competition with the hedge funds, it is driving up prices, it is making it harder for us to do business, but we don't just buy them in these large quantities and not care what we get. We're very, very specific. We know exactly what we're looking for, the price points that we're looking for, et cetera, et cetera. And when we target neighborhoods where rental values are high and resale values are consistent, and I'm going to talk more about that when we talk about the location that we're in now. Okay, I've already mentioned this. We buy REOs, foreclosures, private party sales. We actually have a relationship with regional and even some bigger banks now because we've been doing this, for over 5 years. And again, I want to really emphasize this. We do not buy any type of bulk list tapes, etc. We are on the ground. We have a ground team that researches every single home. We, and I'm not exaggerating when out of 100 properties, we're lucky to get 5 that meet our stringent criteria. When it says we buy based on the yield, not on the comp, you know, some of these neighborhoods across the United States are still hit so bad, you can't really get a comp anymore. What we do is we know how much the house is going to rent for. We know what it was worth before, and we're still buying them under current market value. Okay, but the bottom line, what we're looking for is to buy a house at a reasonable amount and have our clients receive a reasonable amount of yield on their investment, or ROI. We provide fully managed systems to assist you, whether it's short-term or long-term. We have the infrastructure, it's on the ground. Okay, Charlie alluded to this before too, and this is a really important slide. We all get phone calls constantly. Well, I want a house in California, Nevada, or Arizona. And this slide will clearly illustrate why we're not there, and we'll make a few comments about it. But here's the simple way to look at it. If you bought one property in California, Nevada, or Arizona, you would get an average rent, and I'm finding out this is actually a little high now, of $2,200 a month. By the time, you know, and I know many people may not be familiar in California, that may have property taxes that are $800 to $1,200 per month. So by the time you pay the taxes, the insurance, the management fees, etc., it's not a winning proposition. Now versus buying 10 homes in our marketplace, you know, at $50,000 each, they're going to pay an average rent of over $7,000 a month. Our average is $735. So do the math. It's just that simple. We go into areas that you're going to get the most for your money, okay? And obviously, not just the cash flow, but diversity in your portfolio. Okay, we're in Birmingham, Alabama, and I'm just going to go over some statistics here. Hang on just a second. A lot of people don't know when they say Birmingham. A lot of people go, huh? Birmingham? Where's that? Birmingham is actually the 9th largest city in the United States. And a lot of people find that really shocking, but you can look that up on your own. CNN Money basically named Birmingham the 10th best overall real estate market in the U.S., period. They also said that Birmingham is the 3rd fastest growing real estate market in the nation. New Wire took a look at the 10 best cash flowing markets in the United States, and Birmingham was 3rd. Okay, and one of the things that's driving Birmingham right now is there's so much to talk about on the revitalization, their economic development, and you know the joke is that bringing the magic back into the Magic City. Okay, I'm going to start off on this, Charlie, but I really want, I know I keep on asking you to make those comments about the Better Business Bureau because I always forget them, but basically you're looking at pictures of the ballpark. There was the minor league ballpark basically left Birmingham, and they have come back, and there's just literally tens, if not hundreds of millions of dollars going into this total revitalization of downtown. What I think is really cool, because I'm from Chicago, and I remember living in areas like this where they have lofts. You know, I love these city lofts where they convert old buildings. They've got restaurants. Charlie, you alluded to, you know, they have a Zagat-rated restaurant, you know, right there in downtown Birmingham, and I'm sure there'll be a lot more to come. But Charlie, can you share a little bit more about the Better Business Bureau and some of the other things that you found out recently?
Yeah, and I meant to put that slide up today, Greg. I didn't have time, but yeah, the Better Business Bureau in Birmingham just reported about a month ago that in 2012, that Birmingham had 3 times the amount of investment dollars invested into the infrastructure in that city than at any time in their history. A lot of that has to do, as Greg talked about, if you remember, a guy named Michael Jordan decided to go play baseball some time ago. He played for the Birmingham Barons, and the stadium then was an old dilapidated field out in the suburbs. What they've done is they've really moved that stadium into the city. So the stadium is now literally in the city. It's a first-class minor league ballpark, but the city now has, you know, it's become quite a bustling downtown. I pulled this article out of the New York Times just earlier this month talking about the city and what sort of happened in Birmingham. But as Greg said, essentially, that you're seeing world-renowned restaurants, if you can believe that are in the downtown area of Birmingham now. Birmingham was once a steel city. For those of you that know your history, we know that this is where some things happened in the early 60s with regards to the civil rights movement, and at that time it was a steel city. Now the city is more medicine and financial, so it's much more of a white-collar city. A lot of historical areas in Birmingham. It's a growing area, like Greg talked about. The downtown area there has been totally revitalized with restaurants, nightclubs, that sort of thing. Interestingly, the real estate there continues to climb. I mentioned earlier that in 2011 to 12, the people that bought into REO reseller in 11 saw a 17% sales increase from 2011 to 2012. We're already seeing that climb in 2013. We can't maybe wave a magic wand and give you a definite what that value will increase to in 2013. But we do know that in February it rose 2.8% in 1 month. So I mean, you're already seeing real estate start continue to climb in Birmingham. If you look at statistics, here's the value of homes, the home pricings, and then the red line here is inventory, which you'll see here. Obviously, the market peaked out in 06, 07, and then we saw the crash started to gradually decline. And this is where we were typically buying our homes, right in this area here, 9, 10, and 11. And you can see where home inventories were. They're way up here. Well, home inventories now are lower. As Greg said, it's not 10 to get, look at 100 to get 10. It's more like look at 100 to get 5. And that's just because of the fact that you're just seeing a decrease in inventory, but prices continue to climb. Now, what does that mean? It just means the market shifted. The reason you're all on this webinar today, we made an advertisement about, no tenants, no toilets, no trouble, and we're going to talk about something that's very, very unique. But because the market shifted, we want to take better advantage of that market. And Birmingham is a market that has really been left alone for the most part when it comes to the hedge fund influence. Those funds have typically attacked other markets like Atlanta, Las Vegas, Phoenix, some places in the Carolinas, certainly Florida. But Birmingham was a place that only in the last probably 60 days has shown up on their radar to where they're going into that market. And the reasons are simple. It's all things we talked about. It's a strong market. Greg talked about New Wire. That's one of the best statistical groups you can apply to. Called the third best cash flow market. Typically, the cash flowing model in Birmingham is 10 to 14%, or in other parts of the country, the cap rates can be as low as 5%. In California, where we're at, like Greg did mention, we have a portfolio right now, a small portfolio in California. The cap rates are 5%. You can't find cap rates that low in Birmingham. The value of the real estate there has remained very, very strong and continue to get stronger.
All right, I'm going to go over a few of these slides. We're just going to breeze through these. Excuse me. But I want to give you an idea of, what kind of house, $50,000. What kind of house does that buy? In California, people have a hard time getting their arms and minds around, well, wow, these must be dumps. These must be in bad neighborhoods. These must be awful. So I just want to show you 5 examples. Some of these are a year old too. Some of them are literally a month old. But you can see by the pictures, it's a nice little home and a nice tree-lined street. You can see the rehabs are very nice wooden floors. This one's prettier than a lot of them. But just take a look at the homes. And, these are nice little homes in nice family neighborhoods. And these typically rent for an average of about $735 a month. So you do the math, at an average of $735, you're cash flowing really, really, really nice. And there's a high demand, for these type of homes. Charlie, you can keep on going. Here's a monster. Don't care for the pain. Oh, if you could just pause there. I wanted to give people an idea. We don't buy. You can go ahead and get on Realtor.com or whatever it is, and you might find a home in Birmingham that's $2,000, $7,000, $12,000, even $15,000, and you think, oh well, wait a second, what's that? And the reason I'm going over this is, there are homes in every city that are just so dilapidated, it'd be better just to tear those homes down. Okay. Now, you can see, this is before rehab. It's not so bad. It's still a nice-looking home. It did need some work, etc. Obviously, you can see all the multicolored rooms. The kitchen got wrecked. The back deck was a little bit of a mess. There's some roofing issues, on and on and on and on. Charlie, if you could just go to the next slide. This is afterwards, okay? You can see a lot of money was spent on those flooring. That's a very high quality laminate, similar to like the fake hardwoods. You can see the kitchen turned out real nice. The deck is aligned and perfect. You can see brand new air conditioning unit. On and on and on and on. This is a home that we sell all day long for $49,900. I don't know for how long, but this is what we're selling now. And I only say that jokingly because prices are really going up that much. The problem that we're having right now is we need to expand and take better advantage of more of these homes than we're quite honestly financially able to. Okay, we're going to start this program out small. Okay, it is. I'm being serious. This is not a marketing gimmick or anything. It's for the first 10 investors, and we already got 5 off the last webinar. Okay, so if you're serious, just please get a hold of us. We'll work something out. But this is the advertisement that we put out, and it's no tenants, no toilets, no trouble, and learn how to make 50% return on your investment per year. And after we go through these next few slides, that may sound like pie in the sky, but when you see how we break it down, it is way more than realistic. And Charlie, you can go to the next slide. Okay, I'm just going to give an example here. And the reason I'm giving this example is this is the homes that we deal with quite often. But being that the hedge funds are getting involved, there's also certain inventory that we want to purchase to resell to them also. Okay, but $35,000 is the minimum, and I want to just kind of explain how it goes. If a client's interested, basically they invest $35,000. It goes into escrow, you buy the home. It covers everything that we need to do to get it rent ready, pay internal fees, our ground crews, closing costs, et cetera, et cetera, et cetera. Okay. We know that we can sell that home all day long for $50,000. In selling that home for $50,000, there's always about $4,000 in commissions and fees. Okay. In addition to that, at the $50,000 price point, there's going to be about $1,000 in closing costs. So that basically brings it down to there's $45,000 in gross proceeds. All right, there's expenses, and I'm just doing this to illustrate. I'm just taking the example that it takes 90 days to resell this home, okay, at $50,000. You can see that 3 months of taxes are going to be about $180. The insurance is going to be about $150. We do put alarms on during the rehab. They can come off afterwards, but I'm going to say any place in the country now, there are, and I'm talking in nice neighborhoods too, the best of the best neighborhoods, there are professional people that go in at night and steal all of the copper, the wiring. It's a sick business, but it's happening in every city and state across the United States. And then we also, when we resell them to the purchaser who wants to be the long-term holder, we also include a home warranty, which has a cost of $400. So that's $838 worth of expenses. You can go to the next one. All right. So basically the net proceeds are $44,162. The initial investment was $35,000. Okay. The profit is a little over $9,000. And we split it 50-50. It's a joint venture deal. The investor gets $4,581. REO reseller gets $4,581. That's a 13% return on your investment. Now, in some cases, it might be 30 days. In some cases, it might be 120 days. But we feel very confident that we could do it 4 times a year. You don't have to. You can just do it once. Make about 13% and go ahead on your merry way. I'm looking to develop a relationship just for right now, just with 10 people, okay? And that will expand, but I don't want to, take in too much money, not be able to spend it in the right way, and be pressed to buy nothing less than perfect inventory. You can go to the next slide. So you do it 4 times a year. It's a total of $18,324 in total profit. Do the math. It's a 52% total annual return or return on your investment. Again, I want to emphasize the 35 is something that we've been doing for a long time, the $50,000 homes. What I'd like to talk about now is there's also opportunities, and I would tell you the best opportunities are in about the $70,000 range. You're not going to get that much more in return on investment. In fact, Charlie, I'm going to go ahead and turn this part over to you because you work with the hedge funds. Explain to them what their criteria is, why they're willing to buy, and why they're willing to buy so quickly.
Well, you know, they see the market very similar to how we see the market. First of all, I mean, there's no real mystery as to what they see. They see a market that's can be taken advantage of, and that's what hedge funds do. They go into markets that have been disconnected, that they can go into, and they can buy assets at a bargain, sit on them for a period of time, and sell them at a profit. What Greg's referring to here is that it's actually two things. The first thing is the model that he originally described, that $50,000 model, that's just the bread and butter model. You can sell those all day long. It's $50,000. What Greg's referring to is for a higher investment, you know, $60,000 to $70,000, you can buy homes in that category that fit the criteria of the hedge fund. They actually publicize what their criteria is, and typically it goes like this: 3-bedroom at least, 2 baths, at least 1,200 square feet, has to have at least a garage or a carport. Typically, it's got to be somewhere between 1980 and 1990 and newer. In the Birmingham market, we believe we can probably get down to 1975 or newer. They look for newer homes. So they have a set criteria that they essentially just put out there. And the beauty of that is simply this, and I talked about at the front end of my presentation, is that the hedge funds will buy even before you're done with a rehab process. So in many cases, the people that do a model or have a model similar to what you're seeing here, they'll have these homes sold before they're even done rehab yet. The hedge funds will come in and say, those fit our criteria. They put it into their model. If the financial model works, they'll simply go under contract. So in many cases, when Greg talks about, you know, it could take anywhere from 30 to 90 days to get it sold, yeah, that's true with the $50,000 house. But on a more expensive home that fits the hedge fund's criteria, I mean, literally, you're going to have those homes sold before you're even done with the rehab work yet. And typically, interestingly, they don't even want to have tenants in there. They like to do their own tenant installation themselves as well. So in many cases, they'd rather pre-qualify their own tenant, have their own tenant, you know, have that tenant find their own lease and that sort of thing. So in many cases, that higher price model can be extremely attractive too, because you know in those cases that you've got a built-in, you know, buying system to absorb those once the rehab's complete.
Sorry about that. I had to tune out for a minute. I had to close the window. Yeah, so basically, if you're interested, this is Charlie's and my contact information. You can call either one of us, or you can email us. Charlie, is there anything else you want to add before we sign off? Or do we have any questions in the queue?
Yeah, we're going to take some questions. We have some up here. Let me see if I can do. I would like a copy of the recording also. I did not receive a copy of the last webinar, K West. Did we not send that out? I apologize about that. We thought we sent that out. We'll get this the recording for one of these two out to everyone on the list today. And then the next question is, Greg. Okay, there's a personal message here with regards to a sort of a different investment opportunity. We'll give you a call back and we can discuss that. We had one other question here. It says you mentioned that you do not use comps. Why? Greg, you could explain it. I'll tell you what, I'll take a stab at that one first, though. Greg, you cited a couple of really good reasons. The people who do comps on homes now have been greatly restricted because of what happened in 2000 to 2008, I suppose. But there's another reason for it too. You can't buy based on comps, even if you were buying a home for yourself in a neighborhood to live in. And here's the reason why. Most of the homes that are being sold today aren't being sold on the market, or being sold on the market. They're being sold off market. These homes don't go on the MLS. These companies that are buying, these hedge funds that are buying, these things aren't on the MLS. So they're not. You can't gauge what the. Well, let me rephrase that. You can only gauge a part of the market. The part of the market that's used for somebody buying a single-family home to move into and live in. You can't gauge the market in investment real estate because 99% of that stuff happens off-market. Greg, anything to add to that?
Yeah, the other thing I'll add to that is in a lot of the areas that we buy, it's not untypical to have a comp on the one end of one street alone where all the homes are, look from the outside pretty much the same, but you might get a comp on one for $60,000, and you might get a comp on one that's $15,000 because it's a teardown. And so when it comes to actually looking at recent sales, typically most of the sales they're not buyers looking to move in. They're investors like us, like you, like hedge funds that are looking to get the best opportunity on them. So, you may have 15 homes on one street that all average out to like the high 50s, low 60s, and then you'll have two that'll have ridiculous numbers that may also be in good condition. That's only worth a much lesser amount. And like Charlie said, a lot of the industry professionals, they got their hands slapped very hard, and even in areas that are really, really steady, I found something interesting in Berkeley, Berkeley, California. They never went down. I mean, and they're going up, and it's a crazy market. You may be able to get a legitimate comp there, but in a lot of the markets that we go to, it's hard pressed to really get an accurate gauge unless you're on the ground looking at the house. I don't trust them.
Okay, a couple more questions here real quick that I'll answer real fast. The answer to your question, one of the questions is yes, we do pay a referral fee. If you've got somebody that you'd like to refer to us, we will pay you a fee. If you contact me, I can explain to you how that works. Can you work with a full custodian self-directed IRA account such as Equity Trust? We do that every day. We don't. Most of our transactions are qualified transactions. Depending upon the structure of your account context, we actually have somebody on staff that works with our clients to help them through the maze of paperwork that you have to go through when you want to do something like that. But yes, we do do that. How long do you expect this institutional demand will last? As long as the inventory is there. I mean, that's a I hate sort of an obvious answer. I mean, the hedge funds are always going to continue to buy as long as they can find inventory. How long do we think the inventory will be available? I think it depends on the market. I think if you're trying to buy in Phoenix or Vegas or California, I pointed out California for a reason. I mentioned Orange County. If you buy some, people always say, Charlie, I live in Orange County. Why don't you buy flips? You can't make any money in California, and you're buying in a market that they're saying is the most overpriced market in the country. Why would you want to buy an investment property in a market that every statistic says that's an overpriced market? What that typically means is it's going to go down. So the appreciation isn't there. So the answer is as long as institutional investors can get the rate of return they're looking for, until that model changes, it's not going to go away. So I think there's two parts of that. Does the rental market stay strong? And we have the strongest rental market we've had in the history of our country right now today because of the number of people who lost their homes. Will the inventory remain available? And as Greg said, we're not finding as much inventory, but the whole point of this particular type of an offering is to take advantage of it. What inventory is out there, buy it and flip it, buy it and flip it, buy it and flip it. That's what the smart investors are doing. Interestingly, 2 years ago, our model was a buy and flip model. And then we started saying to people, nope, now it's a buy and hold model. And that was the right strategy because the people that bought in 2009 and 10 and 11, the ones that held, they've seen the market come back. So if they were buying in at $39,000, the value of their homes went up. Now we're saying, you've got buyers out there. If you can make a 10 or 12 or 13% hit on your money in 3 months and then do it again and again and again and again, that's the right model. The answer, I think, to that question is that they're going to be around for as long as the inventory is available and the market stays and the rental market stays strong.
Yeah, Charlie, I'd like to add to that. It could be a year, it could be 5 years. There's a lot of predictions. There's a lot of information out there, a lot of, contradictions. Here's the bottom line. Regardless of how long we have, the returns as you move forward as a buy and hold, your returns will go lower and lower. In other words, those smaller houses we mentioned, they all average rents is about $735. Well, the price of the homes is getting higher and continues to rise, but those aren't going to rent for any more, and that's pretty much true across the whole entire country. So, bottom line is the opportunity is going to be around for a while, but the amount you're going to earn will obviously go down as prices come up.
And the other piece of that too is that prices will eventually go up as well. There's a question here: can you invest less than $35,000? Only if you're going to partner up with somebody else. And there's another part to that answer to that question. You don't want to invest less than $35,000. If you start investing in stuff that, as Greg alluded to, costs $15,000 to buy, that may sound great on paper and all, but if it's $15,000, there's a reason for that. And the reason typically is the house is probably getting gutted. You're going to go in there and you're going to spend $30,000 and 6 months time doing rehab work. It's just not worth that. It's just not worth your investment.
I agree with that.
I don't have any other questions in the queue. We'll sit here for another minute or so and see if anything else pops up. We've got our numbers up here, obviously, so if you've got questions, you can call myself or Greg. We'll be doing 2 more of these next week. For those that asked about referral fees, if you got somebody you want to refer, just do us a favor and let us know who you're referring so we know who to compensate if someone is to make one of these investments. So we have another question here. I have to put my glasses back on. Greg, where are you incorporated? I know the answer to that, but where are you incorporated?
We're a Nevada corporation. And just so everyone knows, it wasn't for a tax saving thing. I lived in Las Vegas for 11 years. So when the company was incorporated, we incorporated it in Nevada because I lived there.
Okay, I don't see any other questions. I will hang here for another minute, though, if anybody else has got any questions. We'll leave our numbers up here. Greg, thanks for being here. We'll connect in about 30 minutes.
All right, sounds good.
I want to thank you, everybody, for being here today. And if you got any questions, give us a call. And for those that had some questions off topic, I will be giving you a call back within 5 minutes at the end of this webinar.
All right, I'm going to go ahead and sign off. Thanks to everybody for being here. Really appreciate it.